Life is unpredictable, right? Same goes for the stock market. You never know when the market will take a downturn and your stocks will all be in red. But just like you buy different types of insurances like car insurance, home insurance and health insurance to financially protect yourself from the unexpected events of life, similarly you can buy protection for your investments in the stock market. The act of protecting your stock portfolio from a market downturn is called hedging. The way hedging strategies work is if your stock investments take a nosedive, the hedges you bought will go up. And this will help to make up for some or all of the losses in your portfolio. In this video, we'll be talking about 5 ways to hedge your portfolio. But just like insurance, it is not free. You have to pay a direct or indirect cost to keep your investments safe. And remember, hedging strategies don't last forever. You need to renew them just like you do with your insurances. So, in this video, we'll talk about the good and the not so good side of hedging your stock portfolio. My name is Kanak and welcome back to my channel. To learn more about investing, subscribe to the channel and show your support by liking the video and sharing your thoughts in the comment section below. So the first popular way to protect your investment is by buying options. Think of options like buying a special kind of contract through your brokerage account, just like buying stocks. Now, how do options work? Well, when you buy an option, you're basically paying money, which is called premium, to buy the right to either sell or buy a stock at a certain price before the expiry date of the option. It's important to know that option gives you a choice. It does not obligate you. You don't have to sell or buy the stocks if you think it is not in your favor. When you buy a put option, it means you are buying the right to sell a stock at a specific price called the strike price. If you buy a call option, it means you are buying the right to buy a stock at the strike price. Now let us understand hedging through options using a simple example. Let's say you own one stock of Google which you bought for $100. You think the price of Google stock will drop in the next 6 months. So to protect your investment, you decide to buy a put option for Google at the strike price of $100 that expires in the next 6 months. And each put option costs you $5. Now if the stock price of Google falls below $100 in the next 6 months, you can use your put option. This means you can exercise your right to sell your stocks at $100 even if the market price is lower than $100. However, because you paid $5 upfront for the option, it will only be profitable if the stock price drops below $95. But if the stock price of Google does not fall below $95, then basically you lost the premium that you paid for the put option. You can buy options not only for single stocks, but also for things like ETFs or indexes such as the S&P 500 or Nasdaq 100. The example I just explained is the easiest way to protect your portfolio using a put option. However, I have made another video where I talk about the different option strategies. These strategies use both put and call options to safeguard your portfolio. Another interesting way to protect part of your portfolio from losses is by buying an inverse ETF. But what exactly is an inverse ETF? Well, it's pretty straightforward. An inverse ETF moves in the opposite direction to its regular counterpart. For instance, if the S&P 500 ETF drops by 1%, the inverse S&P 500 ETF will rise by 1%. However, if the S&P 500 goes up by 1%, the inverse ETF will fall by 1%. Let us say you have one share of WU, an S&P 500 ETF, and you think it will drop by 5% in the next month. To shield yourself from this potential loss, you can buy one share of ProShare Short S&P 500 ETF, which moves inversely to the S&P 500 index. So, if WU does drop, the inverse ETF will rise, helping you offset your losses. But remember, inverse ETFs might not perfectly mirror the percentage changes of their regular counterpart. They are rebalanced daily, so they only aim to reverse the price change of one day at a time. This means they might not have the same compounding effect as regular ETFs, leading to some differences in correlation. Additionally, holding inverse ETFs involves fees and transactional cost. They are best suited for short-term portfolio hedging. Now, interestingly, there are not only 1x inverse ETFs, but also 2x or 3x inverse ETFs available. This means if the original ETF drops by 1%, the 2x inverse ETF will rise by 2% and the 3x inverse ETF will rise by 3%. But be careful, especially with the 2x and the 3x inverse ETFs. They can quickly increase your losses if the original ETF's price skyrockets. Now let's discuss another interesting method to protect your portfolio, buying VIX. But what is VIX? Simply put, it is volatility index. This index measures how much fear and uncertainty there is in the stock market. So when the stock market crashes, the index goes up. But when the stock market goes up, the index goes down. As you can see, during the global financial crisis in October 2008 and the COVID-19 pandemic crash in March of 2020, the VIX index spiked. This means the index moved in opposite direction of the market. Now the good news is there are ETFs that follow the VIX index. Some examples are ETFs with ticker symbol VXZ and VIXM. These ETFs rise when the stock market falls, but fall when the stock market is stable or rises. However, there is a big catch with using VIX ETFs to hedge your portfolio. They are not a perfect hedge. This means if the market drops by 10%, the VIX might not necessarily go up by exactly 10%. Plus, there are fees, transactional cost, price decay, and other risks involved in holding VIX ETFs for the long term. Effectively, if you're holding VIX for a very long time and the market does not crash, then you're slowly losing money every day. So buying VIX ETFs is an imperfect way to hedge your portfolio and is best suited for the short-term protection. It is not a good idea to hold on to these ETFs for the long haul. Another important way to make your portfolio safer is by investing in different and uncorrelated assets. This means spreading your money across things that don't all move in the same direction. You can diversify your investments in stocks, real estate, gold, bonds, savings account, and even across different countries. The good thing about investing in assets that are not correlated is that when one goes down, the other might go up. So if a part of your portfolio isn't doing well, you can still make money from the other parts. And because you have spread your investment out, you don't have to sell the ones that aren't doing well right away. You can hold on to them until things get better. Diversification is one of the cheapest and safest ways to protect your portfolio. But there is a downside. By spreading your money out, you might reduce your long-term returns. Over time, things like bonds, savings account, and gold tend to give lower returns compared to stocks. However, they offer stability and steady source of income. If you are worried about the stock market crashing, one way to protect your investment is by selling some of your stocks and holding on to cash instead. You don't have to sell everything, just part of your portfolio or certain stocks. How much you choose to sell depends on how confident you are in your research and prediction about the market or specific stocks. But keep in mind, holding on to cash is not completely free. When you sell your stocks and hold cash, you're trying to time the market, which means you might miss out on potential future gains. Historically, keeping your money in savings account has not been very profitable. In fact, the returns are often lower than inflation, which means your money loses value over time. Plus, looking back, the stock market has ended positively in about 2 out of every 3 years. So while hedging with cash does not have a direct cost, there is an indirect cost in missed opportunities. If hedging seems too costly, risky, or short-term for you, remember that long-term investors skip all of that by ignoring short-term price changes and focusing on the long-term picture. But to be a long-term investor, you need to choose your investments that you can stick with for decades. Plus, you should be in a position where you do not need to cash out your investments right away. That way, you won't stress out over the short-term ups and downs of the market. Now let me know your thoughts about hedging in the comment section below. And thanks for watching this video.